So, I mean, if you think back to July 2024, CrowdStrike accidentally crippled the global internet, like literally grounded flights, shut down hospitals, and essentially took the entire digital world offline.
Yeah, it was unprecedented.
Right, completely unprecedented. And usually when a tech company causes, the biggest IT failure in modern history, you'd assume they're entering a decade-long penalty box.
Oh, absolutely. That kind of brand impairment is supposed to be fatal.
Exactly. But today, June 3, 2026, the market has priced them at absolute undeniable perfection. I mean, their stock is sitting at an all-time high of $748, and they are trading at a staggering 171 times trailing earnings.
Which is just a wild number.
It's insane. So how does the most catastrophic software failure in recent memory spark, the greatest comeback story in modern tech?
It's an incredible paradox, really. Instead of entering this death spiral of lost trust, they didn't just survive, they fundamentally rewired how the market perceives their value.
And that is exactly what we're unpacking for you today on this deep dive. We've got a massive stack of sources on the table. We are analyzing CrowdStrike's Q1 fiscal 2027 earnings report, the highly anticipated earnings call transcripts with CEO George Kurtz, and a deeply critical analyst scorecard that looks at the actual mechanics of their business.
Yeah, it's a really comprehensive look under the hood.
Right. And our mission today is to answer one crucial question for you. Is this company actually executing a flawless business strategy, or is Wall Street just getting completely swept up in the whole artificial intelligence hype cycle?
Because we really need to separate the underlying physics of their cash flow from the narrative that the market is so enthusiastically dying into.
Oh, 100%. At a valuation multiple this extreme, the narrative and the numbers have to be perfectly aligned. But before we get into the architecture of this turnaround, I need to make one thing absolutely crystal clear up front.
Always good to set the ground rules.
Yep. This deep dive is purely for educational purposes. This is definitively not investment advice. We're just here to analyze the reports, break down the underlying business mechanics, and share the facts from our sources. Please always do your own research before making any financial decisions.
Exactly. We're looking at how a business machine operates, not giving you a blueprint for your portfolio.
Okay, let's unpack this. If we want to understand how a company goes from a global outage to a 171 trailing PE ratio, which for anyone unfamiliar with the jargon, basically means investors are willing to pay $171 today for every single dollar of profit the company made over the last year. We have to look at their rebranding.
Yeah, the rebrand is the core of this whole story.
Because they're no longer selling themselves as just a traditional cybersecurity firm. It's like shifting from being the security guard at a local bank to being the exclusive security force for the Federal Reserve of the AI boom.
That's a great analogy because the traditional model was just, endpoint security. You install an agent on a corporate laptop to stop a hacker.
Right. Necessary, but kind of boring.
Very necessary, but it's a known quantity. The massive shift we are seeing in these transcripts is CrowdStrike positioning themselves as critical AI infrastructure.
And I saw CEO George Kurtz refer to this pivot on the earnings call as their mythos moment that happened back in April. What exactly is a mythos moment, and why is Wall Street treating it like the Holy Grail?
So the Mythos moment was essentially the ultimate industry validation. In April, Kurtz announced that CrowdStrike was selected from the very beginning by both OpenAI and Anthropic to secure their frontier models.
Wait, both of them?
Both of them.
So the two absolute heavyweights building the foundation of generative AI both looked at the entire cybersecurity landscape and independently chose CrowdStrike.
Yeah, and the mechanism of why this matters is just fascinating. Because securing a frontier AI model isn't like securing a standard corporate database. Well, you have to protect the raw training data, you have to protect the model weights, which are the literal brain of the AI, and you have to secure the API inputs against completely new vulnerabilities. Things like prompt injection attacks, where a user tries to trick the AI into leaking its secrets.
Oh, wow. Yeah, that's a whole different level of threat.
Exactly. So, by being chosen to protect the most valuable, heavily targeted intellectual property on the planet, CrowdStrike sent a massive signal to the Fortune 500.
It's the ultimate social proof. I mean, if you're a bank or a healthcare giant building an AI application, you're obviously going to look at what OpenAI uses to protect their own house.
Precisely. Kurtz literally stated on the call that after this Mythos event, more happened in a matter of weeks in the cybersecurity space than in the entire year prior.
That's wild.
And they capitalized on that validation by launching a completely new product category, AI, or AI detection and response.
Yes, I saw that acronym all over the earnings report, AIDR. And the numbers attached to it are just staggering. The annual recurring revenue, the ARR, for this specific product grew 250% sequentially.
Yeah, it's massive.
They're walking into Q2 with a pipeline sitting at over $50 million just for this new pillar.
It is explosive growth, but we do need to keep those percentages grounded in reality. 250% sequential growth sounds unprecedented, but remember, they are building this from a near-zero baseline compared to their core endpoint business.
That's a good point. Small numbers grow fast.
Right. When you launch a brand new module, early adoption numbers will always look like a rocket ship. The real test is whether they can sustain it.
That's a fair reality check. But Kurt seems entirely convinced. I mean, he went on record saying that AIDR is actually a larger overall opportunity than their original endpoint detection business.
Which is saying something, considering the size of that core business.
Exactly. He said, and I quote, "In my career, I've never seen adoption happen this fast." And they aren't just selling this software in isolation, right? The sources detail something called Project Quiltworks.
Yes, Project Quiltworks is a brilliant structural move. They are mobilizing massive global consulting giants Accenture, EY, IBM, along with OpenAI and major insurance companies to tackle frontier AI risk as a unified coalition.
So it's not just a direct sales pitch anymore.
No, exactly. Instead of CrowdStrike just knocking on a company's door trying to sell software, you have an IBM consultant walking in to help a massive enterprise build their whole AI strategy. And CrowdStrike is already baked into the blueprint.
They are embedding themselves into the very foundation of corporate AI adoption. So the narrative is incredibly compelling. But if enterprises are genuinely adopting this AI DR at the rate Kurtz claims, we should see that reflected immediately in that cash flow.
We should, yeah.
Let's look at the scoreboard. Does the Q1 financial print actually prove this mythos moment is real?
What's fascinating here is that the scoreboard absolutely reflects the narrative. If we look at the quarter covering February through April of 2026, the numbers are just dominant. Total annual recurring revenue hit $5.451 billion.
Wow.
That is up 24% year over year. But the number analysts really care about is net new ARR, the fresh business they brought in during those 3 months. That hit a record $256 million, up 32%.
And their overall revenue growth rate of 26% has now accelerated for the fourth straight quarter. But I'm looking at these top-line numbers, and I have to push back a little here.
Sure, go for it.
What is the cost of this growth? Because the classic Silicon Valley playbook, especially in a hype cycle, is to burn cash to buy market share. You spend $2 on aggressive marketing and sales just to acquire $1 of new revenue. Is this just growth at all costs?
That is the exact trap many high-growth software companies fall into. But what's fascinating here is that CrowdStrike is completely bucking that trend. As their top-line growth accelerates, their profitability is actually expanding right alongside it.
Really?
Yeah. In Q1, they generated a record $468 million in free cash flow. That means for every single dollar of revenue that came in the door, 34 cents dropped straight down to cash in the bank.
Okay, that's huge.
And they also posted a Q1 record operating margin of 24%.
A 34% free cash flow margin while growing revenue at 26%. That's a really rare combination in tech.
It's elite. In the software industry, there's a benchmark called the Rule of 40, used to measure a company's balance of growth and profitability. You simply add the revenue growth rate to the profit margin.
Right, and if it's over 40, you're golden.
Exactly. If the combined number is over 40, it's considered a highly efficient world-class business. CrowdStrike's Rule of 40 for this quarter was 49. And if you use that massive free cash flow margin instead of operating margin, their Rule of 40 is a staggering 59.
59. That brings us to the mechanics of it. How are they actually doing this? Because you don't hit a Rule of 40 score of 59 just by having a good sales quarter. There has to be a structural advantage in how they build and deliver their software.
You hit the nail on the head. It all comes down to their architecture, specifically what they call the platform consolidation flywheel.
Okay, break that down for us.
From day one, CrowdStrike built their technology on a single lightweight software agent called Falcon. Historically, if a company wanted endpoint protection, cloud security, and identity threat detection, they had to buy 3 different clunky programs from 3 different vendors.
And install them all and probably crash their servers in the process.
Exactly. But with CrowdStrike, the customer installs one single agent. All the other services are just modules that get activated from the cloud.
It really is like a smartphone. You buy the physical phone with the operating system, and when you want a new capability, you don't go buy a new device, you just download an app. The infrastructure is already there.
That's a perfect way to look at it.
Yeah.
And the financial impact of that architecture is profound. Because activating a new module is virtually frictionless, customers are buying more and more of them.
Right. It's an easy upsell.
They rolled out a subscription model called Falcon Flex, which is essentially an all-you-can-eat structure letting customers easily swap and consume different modules as their needs change. The ARR for Falcon Flex just hit $1.9 billion.
Wow.
That's up 99%. Today, 51% of their customers are using 6 or more of these modules.
Wait, over half of their massive enterprise base is locked into 6 different tools on the platform?
Yep.
And from a cost perspective, when a customer decides to add that 6th or 7th module, CrowdStrike doesn't have to spend a fortune on a new marketing campaign to win a new logo. They are just upselling a captive audience.
Precisely. They just flip a switch on the back end. That frictionless upsell is why their gross margins are sitting at a record 79%, and why that free cash flow is exploding.
Makes total sense.
And we are seeing this architecture allow them to swallow up entirely new markets. For example, their next-gen SIEM product.
Let me stop you there. What exactly is SIEM?
SIEM stands for Security Information and Event Management. Think of it as the central nervous system of a company's IT department. It collects logs and data from every server, laptop, and firewall to look for suspicious patterns.
Sounds like a massive data headache.
Oh, it is. Legacy SIEM systems are notoriously slow, incredibly expensive, and really clunky. But CrowdStrike is using their proprietary AI, trained on their massive threat graph data, to process those logs faster and cheaper. And that specific next-gen SIEM module just crossed the $600 million ARR mark.
Okay, so the picture here is incredibly robust. They have the ultimate validation from the AI pioneers, their top-line growth is accelerating, and their single-agent architecture is basically printing cash at elite margins. It sounds bulletproof.
It does on paper.
Here's where it gets really interesting because we have to pivot to the tension in our sources. The market isn't blind to any of this. The stock ran from around $390 at the close of the prior quarter all the way up to $748 today.
A massive run-up.
And that valuation, 171 times earnings, means the market isn't just pricing in a great company, it's pricing in a flawless future.
They are priced for absolute perfection. There is no room for error.
So here is my challenge, based on the analyst scorecard we have. If they have this brilliant single-agent architecture, and half their customers are deeply entrenched with 6 or more modules, why on earth does the analyst report rate CrowdStrike's economic moat as only narrow instead of wide?
If we connect this to the bigger picture, the analyst's narrow rating actually highlights a fascinating vulnerability. It really validates the bear case. While CrowdStrike's architecture and their massive data advantage are incredible, the environment they are operating in is inherently treacherous.
How so?
The irony is, the very technology they are championing, artificial intelligence, is actually eroding the traditional moats of the software industry.
Wait, how does AI erode their moat? Aren't they the ones leveraging it the best?
They are, but generative AI fundamentally lowers the barrier to entry for challengers. Historically, to build enterprise-grade security software, you needed thousands of engineers writing code for years.
Right. It was a capital-intensive nightmare.
Today, we are seeing agile startups, like Wiz, for instance, use AI coding copilots to build feature-competitive security modules in a matter of months. AI makes the underdogs exponentially faster, meaning the pace of innovation from smaller challengers is constantly nipping at CrowdStrike's heels.
That makes a lot of sense. The moat isn't as deep because a startup can essentially use AI as a massive engineering shortcut to catch up.
And they aren't just fighting nimble startups, right?
Not at all. They are facing deeply capitalized, fierce competition from legacy giants. Palo Alto Networks and Sentinel are aggressively pushing their own bundled platforms. And then you have the ultimate heavyweight, Microsoft.
Of course, Microsoft.
Microsoft has a massive security business, and they have the ability to simply bundle their security tools into existing enterprise Windows licenses for a fraction of the cost. When budgets get tight, a CFO might look at Microsoft's quote-unquote good enough bundled security and decide they don't need to pay CrowdStrike's premium.
The Microsoft threat is always looming, but the analyst scorecard also pointed out a massive discrepancy in how CrowdStrike defines their profitability, We talked about their record operating margin, but there's a catch in the accounting, isn't there? A very significant catch. There is a massive gap between their non-GAAP profit, which they reported as $283 million, and their actual GAAP net income, which was only $27.8 million.
Wait, that is $250 million in difference. Where exactly is that money going?
It's going to their employees in the form of stock-based compensation. To attract and retain the top software engineering and AI talent in the world, CrowdStrike compensates them heavily with company stock instead of pure cash.
So basically, they are paying their engineers in company shares. I mean, it keeps their bank account full today, which explains the massive free cash flow. But it silently dilutes the everyday investor who owns the stock because there are more and more shares being created. It's a hidden cost of doing business.
Exactly. The headline non-GAAP margins look fantastic, and it is a common practice in tech, but it does overstate the true underlying cash economics. When you factor in that shareholder dilution, it's a real expense. And when we talk about vulnerabilities and moats, we absolutely have to remember the shadow hanging over this entire narrative, the July 2024 outage.
Yeah, you really can't ignore the elephant in the room. They proved that a single bad update can halt global operations.
The analyst report emphasizes that no matter how advanced the platform is, customer trust in cybersecurity is incredibly fragile. When your valuation sits at 171 times earnings, Wall Street is assuming you will never, ever have another July 2024.
They can't afford to.
If they suffer even a minor technical hiccup, or if they miss their revenue guidance by a fraction of a percent, a multiple that high can compress violently. The market forgave them once, they will not forgive them twice.
So what does this all mean? Given this narrow moat, the Microsoft threat, an evaluation that leaves literally zero room for error, how do they justify this price tag over the next 12 to 24 months? If you're listening and tracking this stock, what are the specific milestones you need to watch?
The most critical milestone to watch is how they answer the debate over incremental spend. On the earnings call, CEO George Kurtz insisted that the demand for AI/DR is entirely incremental.
Meaning a company's CFO is finding completely new money, like a new line item in the budget, to pay for AI security rather than cutting their existing IT budget to afford it.
Correct. Kurtz is arguing that AI is viewed as so mission-critical that budget constraints don't apply to it. But analysts want hard proof. Over the next year, we need to see if their net new ARR continues to reaccelerate.
What are the specific numbers they need to hit?
For Q2, they guided to $1.4 billion in total revenue and net new ARR of around $284 to $286 million. They also raised their full-year guidance for net new ARR to between $1.28 and $1.3 billion.
That implies they expect this momentum to keep compounding straight through the end of the year.
It does, but there is a massive execution hurdle built into that guidance. It implies heavy back-half seasonality. Basically, about 58% of their expected new ARR for the entire year has to land in the second half of their fiscal year.
Wow, that puts an immense amount of pressure on their sales teams in Q3 and Q4.
Oh, massive pressure. If the broader economy softens, or if CFOs decide that AI security isn't actually incremental and start delaying purchases, CrowdStrike has a very steep hill to climb to hit those aggressive targets.
So the back half of the year is make or break for this valuation. And beyond this year, what's the ultimate financial destination they are trying to reach?
Management has laid out a long-term arc to reach $10 billion in annual recurring revenue.
$10 billion.
$10 billion. To get from their current $5.5 billion to $10 billion, they have to sustain mid-20s% growth for years. They are relying heavily on the newer modules, AI/DR, Next-Gen SIEM, Identity Protection, to carry that weight.
That's a lot to ask of the new products.
It is. And simultaneously, they are targeting a long-term operating margin expansion to between 25 and 30%. Squeezing out those last few percentage points of efficiency while fighting off relentless competition, well, that will be the ultimate test of their architecture.
To keep investors engaged while they execute this multi-year plan, they're also pulling some major financial levers, aren't they? The transcript outlines an upcoming stock split.
Yes. As a near-term catalyst, they announced a 4-for-1 stock split. It will begin trading split-adjusted on July 2nd.
Now, we need to be clear here. Mechanically, a stock split doesn't change the fundamental value of the company one bit. It is like taking a $100 bill and exchanging it for 5 $20 bills. Your wallet isn't any heavier, the value is identical.
Perfect way to explain it.
But psychologically, bringing the share price down from $748 to roughly $187 makes it much easier for retail investors to buy whole shares.
Yeah, increases the liquidity and accessibility of the stock. And what about the institutional side? I know you saw the notes about an aggressive buyback program.
Yeah, they have $1.3 billion remaining in authorized stock buybacks. And what is brilliant here is their capital allocation timing. In Q1, they actually repurchased $176 million of their own stock at an average price of $365.63.
Wait, they were quietly buying back their own shares in the $300 range, and now the stock is trading at nearly $750.
Exactly. It shows that management had absolute unwavering conviction in their underlying business model during the post-outage recovery.
That's a huge signal to the market.
They are also utilizing catalysts like their upcoming Falcon user conference and pushing deeply into the federal government space with their FedRAMP authorized offerings.
Right, FedRAMP is essentially the incredibly strict security certification required to sell cloud services to U.S. government agencies. Government contracts provide massive, sticky revenue streams that really help insulate them from corporate budget cuts.
So they have the demand, they have the architecture, and they have government expansion. Let's pull all of these threads together. What the sources clearly show is that CrowdStrike has positioned itself masterfully at the direct intersection of legacy enterprise security and the explosive new AI boom.
They really have.
They didn't just survive the reputational disaster of the July 2024 outage. They used it to rebuild their narrative. They posted a complete sweep on their financial scorecard this quarter. The cash flow is elite. The single-agent platform is deeply entrenched in the Fortune 500, and their validation by OpenAI and Anthropic is driving real, quantifiable growth.
It is undeniably one of the most elite software businesses operating today. But the critical takeaway for anyone analyzing these reports is the price tag. At a 171 times trailing multiple, the market has completely eliminated any margin of safety. They are pricing in zero bumps in the road. Not a single lost enterprise contract, not a delayed module rollout, and certainly never another catastrophic update. In an industry where adversaries and competitors are constantly evolving, demanding perfection is a heavy burden to bear.
And as a final reminder to everyone tuning in, this deep dive was strictly an educational analysis of the business mechanics discussed in the June 3, 2026 reports. It is not investment advice. But as we wrap up, I want to leave you with a final, lingering thought to ponder on your own. We've spent this entire deep dive discussing CrowdStrike's new identity as the ultimate security guard, building the critical infrastructure to protect AI from bad actors.
The essential shield for the frontier models.
Exactly. But if generative AI lowers the barrier to entry for coding, as these frontier models become exponentially smarter and exponentially faster at writing complex software, wait, no, let me rephrase that. As they become faster at writing complex software, could that very same AI eventually empower a small, unknown startup or even a solo developer in their garage to build a flawless, instantly deployable security architecture from scratch?
That's the million-dollar question.
Could the very AI that CrowdStrike is protecting eventually generate the exact tools that render their massive single-agent platform obsolete overnight?
It is the ultimate innovator's dilemma for the artificial intelligence age.
Something to keep in mind as this space continues to evolve. Thank you so much for joining us on this deep dive. If you enjoyed unpacking the mechanics of this incredible tech comeback, make sure to subscribe so you never miss an analysis. We'll catch you on the next one.